the Fibonacci retracement tool sucks. Or at least that's what I thought before I experimented with it. I've came to the realization that the Fibonacci retracement tool has drastically simplified my trading style. And in this video, I'll show you exactly how I use the Fibonacci retracement tool to find entries in the market. So first things first, I want to get all the disclaimers out the way. The Fibonacci retracement tool is by far not the best strategy out there. And also in no shape or form am I telling you to use this strategy over something else. I am just simply sharing what has worked for me. So take everything in this video with a grain of salt. Now, let's get into the structure of this video. So first things first is I'm going to be answering three main questions. First, what is the Fibonacci tool? Second, when does it work best? And third, when not to trade it. Because it is very key you have this information before moving on to the tactical implementation of the tool. So the first question, what is the Fibonacci tool? I have two definitions here. One, the Google definition that I searched up prior to this video, and two, my own definition of it. So let's start with the Google definition. The Google definition says here, the Fibonacci retracement levels stemming from the Fibonacci sequence are horizontal lines that indicate where support and resistance are likely to occur. Now, if you don't know what the Fibonacci sequence is, it's just basically a sequence of numbers that each number equals the sum of the two preceding numbers. So for example, I'm gonna have a couple examples up on here. Let's say, for example, 0 plus 1 is going to equal 1, 1 plus 1 is going to equal 2, and then 2 plus 1 is going to equal 3, 2 plus 3 is going to equal 5, and it just goes on like that. This indicator is mainly drawn between two price points, such as a high and a low. And the indicator will create levels that price could potentially retrace to. You see, the significance of it is that Fibonacci numbers are found all throughout nature. Therefore, many traders believe that the Fibonacci levels also hold significance in the market. Now that's Google definition. My definition is very, very simple. Potential zones that pullbacks and retracements can end where that second impulsive leg can start. So let's start off with some drawings to illustrate this point. So I'm going to draw a quick illustration so we can kind of understand the point of how Fibonacci's are used. So this is going to be a buying example. So let's say, for example, we have an uptrend, which means market has a big extension leg up, and then it comes back down to retrace here, right? Fibonacci levels are used to figure out where this retracement may end. So we may draw the start of the Fibonacci right here and the end of the Fibonacci right here. And what it will kind of look like is this may be the 50% level of the Fibonacci. This may be the 75% level of the Fibonacci, and so on. It's just simple lines that you could use as kind of support and resistance to hypothesize, I should say, where the retracement may end. And essentially, you're looking to maybe, let's say this is the 50% level right here. You're looking to essentially buy here and then take it back up to the highs, or expecting it to make new highs. So now that leads us to the second question that we need to answer. When does it work best? And the answer is very, very simple. Trending market. When the market is creating new highs and new lows, that's when the Fibonacci tool works best. So to illustrate another example of what trending markets look like, it's very simple. They just simply look like they're going up and kind of trending in a certain way. If you're an experienced trader, you should be able to understand the point very well. If you don't understand what trending markets are, I would suggest you look into market structure before even continuing with this video. And this is the vice versa for bullish markets, for example. This is what a trending market looks like. As you can see, it just kind of creates new highs and new lows, but the overall trajectory is up. And the same for the bearish markets. It creates new lows, new highs, but the overall trajectory is down. That's a simple explanation of what trending markets is. And the reason why Fibonacci tools work so good in these markets is because there's retracements and extensions. There's something called the three-leg pattern, which is something as simple as an extension leg. This is usually an impulsive leg. And then there's the retracement leg, right? This is usually where you use a Fibonacci tool. And then you're usually expecting about 60 to 70% of the times a new impulsive leg to happen. This is the market conditions, the market patterns you need to see in order for Fibonacci to truly be effective. Now, again, in no shape or form am I trying to tell you what to do. I'm just sharing what has worked best for me, honestly. So remember, take my advice with a grain of salt. Now, getting into the third question, when not to trade it? And the answer is also very simple. Whenever it's ranging in general, usually you should stay away from Fibonacci retracements. So for example, we know when it's trending, it's heading in one overall direction. But when it's ranging, it's usually looking something like this. It looks like a bunch of M's. Usually, sometimes it makes a little new high, sometimes it makes a little new low, but usually, most of the time, it is between two extremes. And sometimes you could just draw a big old box to kind of trap price in. That's mainly what I do to tell if markets is ranging or not. The reason why Fibonacci retracements don't work as good in ranging markets as in trending markets is that I've noticed it's very kind of simple. In trending markets, you're expecting new highs and new lows to be made, and the possibility of that is relatively high. But for the overall structure of trending markets, new highs and new lows aren't really being made. Sometimes they get made, but the move isn't continuous. So it may bounce off a high, bounce off a low, and stay in between this box range. And usually when you're trading Fibonacci's in ranging markets, that's when you're gonna get majority of your losses. So now that we covered exactly what the Fibonacci is, when it works best and when not to trade it, it's time to get into the charts to look at the actual Fibonacci settings I use and how I determine my take profit and also my closing conditions. All right, so first things first, let's get into the settings I use for the Fibonacci. So there's two main settings that I have, or should I say there's two main Fibonacci retracement tools that I mainly use. So the first one that I really use is my Fibonacci extension tool. And here are all the levels that I have. But first, let me show them to you. So I have the 0 level, of course, the 25 level, it's the 62, 1, negative 27, negative 62, 50, 54.3, 79. Now, first things first, there may be two odd levels that you really don't usually see on Fibonacci tools, which is the first one is the 25% level and also the 54 level. Now, I use these levels, I use this level mainly as a entry, or I use this level mainly to kind of balance my risk reward tool to always make sure I'm getting like a standard, maybe 1 to 2 or 1.5. That's what I mainly use this level for. I don't really use it anything for like confluence wise. The main levels that I use for confluence is the 0.5 and the 62. They call this level the golden zone, and this is the level where I'm looking to take my entries. I usually like to see some type of rejection off of these levels. Now, you see this level right here as the red line. It's the 0.79 level. This level I like to use as a stop loss or a potential area to get out of the trade if it comes against me. Now, the reason why I use this level is because I noticed through backtesting, majority of the times, I'm talking about 80% of the times, if price comes all the way down to the 79% level, usually it would always hit my stop loss. So I then now use this level as a point of exit or a closing condition if needed. Now, for take profits, I am a very simple man. Honestly, I just like to get back to the recent high, which would be at the 0 level, and that's pretty much it. You can use these levels as extra take profits if you wanted to, since they are, along the lines of the Fibonacci retracement tool or the Fibonacci sequence, but I really just use 0 because it makes sense to me. Getting out at the recent high is probably the lowest hanging fruit and the highest probability take profit. So that's what I just simply use. Now, this secondary tool here is something new, and I'm gonna be honest with you, I didn't add it on till yesterday. The reason why I use this tool right here is to see the percentage of the retracement, or how deep the retracement came into the previous impulsive leg. Now, I just started using this one, so I'm not gonna go too much in detail about how I use it because it's something new that I'm starting to use, but this one right here is the main one I'll be talking about. So now, I mentioned take profits being at the 0 level for me. You can use these extra levels of take profits, but I mainly use the 0 level as take profit with the 25% level. This is another level that I use to manage my trades. It was just simply a level that if price hits over here, it usually has a higher percentage level of hitting my take profit. So I started using this level to dictate where to drag my stops. If it hits this level, I usually drag my stops to break even or right to the 50% level. So now let me give you some examples so you can see exactly how it's being used. All right, so I'm gonna try and find a quick example. Of course, this is all in hindsight, so it really doesn't hold much weight, but I'm gonna show you live footage of me actually trading this in the live markets at the exact same time so you guys can see how I mainly use it. But for right now, we're gonna look back in hindsight, and I'm also, after this, I'm gonna go into the extra confluences I use with it as well too. So a little example, well, a little perfect example would be this example right here. So we see we have a high here that has been rejected multiple times, right? You would use the fib by looking at this leg. I'm not looking at this leg right now. Let's say this leg didn't happen. So let's say this retracement didn't happen here. We just see this rejection off of this level right here. Cool. So now you would take the Fibonacci, and how you would use it is you would take it from the top and you would drag it from the bottom. Now in this case, it's kind of hard to see the numbers because they're kind of intertwined with the candles. But in this case, what you would be expecting is the retracement to these levels right here. And not every time is going to be spot on. Sometimes it's going to go past it. Sometimes it isn't. But as you can see in this case, your entry could have been right here after this candle closed on the 15. You could have entered right there, and then you could have put stops wherever you wanted to put it. If you wanted to put it up here, you could have. Or if you wanted to bring it down to this resistance, which is most likely probably what I would have done, and then you would have moved it right over here. Now, as the trade goes into drawdown, and now where you want to place your stop loss is dependent on you. Usually I would place it right here, but sometimes you could place it above here. It doesn't matter, it's just solely dependent on where you want to place it. And then it's the exact same for take profit. In my case, I'm always placing it exactly at the recent low that's made, which would have been this low before the retracement. And as you can see, this is an example of it working out pretty well. Now, being honest with you guys, this trade isn't a trade that I'm taking for the main sole reason that I don't have too much confluences behind it. But for the main sole reasons that my confluences really wasn't all lined up. But as you can see, this is a perfect example because price decides to make new lows, which is a condition for when market is trading. So this is a little example of how the Fibonacci tool could be used pretty much here. Being honest with you guys, this is not a trade I'm taking simply because my confluences didn't line up. So that jumps into the next question. What is my main confluences? I have three main confluences that I look at. One, I look for my VWAP. So VWAP here, I kind of use as a moving average, some people like to say. So VWAP here kind of uses a moving average. If I'm looking to buy, I usually like to see price above this blue line. If I'm looking to sell, I usually like to see it below the blue line. But I mainly use VWAP to tell me where the volume direction is. The second confluence that I use, which is by far the most important one, is market structure. Now, I use key levels in markets to determine where the retracement may end as well too. So let's say, for example, in a trade that I actually took, which is this one right here, in a trade that I actually took, which was this one right here, I like to see some type of structure I can use on the 15-minute as a key level. So I like to see some type of support, some type of resistance. If I'm selling, I like to see resistance. So in this case here, I used market structure to be in line or in confluence, as I should say, with my Fibonacci retracement tool here. So that's how I use my second confluence, market structure. I'm just essentially looking for key levels to be in line with the fib as well too. So the next confluence that I use is wick fills. Now, what wick fills essentially are is essentially, if you trade ICT concepts, it's a fill of a fair value gap. If you trade ICT concepts, it's essentially a fill of a fair value gap. I siphoned this observation in the markets from Trades by Matt. He was using it on his live streams, and then as I started to trade going through these funded challenge, I started seeing a lot of these wick fills play out. So say for example, this is a perfect example of a wick fill. Now this candle right here, now if I remove it, if I hide all drawings for a second, and we just look at straight candles, you'll see that this big bearish candle right here left a gap between here and it's closed. And then preceding candle, which is the next candle, continued to go up and essentially fill that gap before coming back down. Now that is a simple illustration of how I use wick fills. It is a second or third confluence that I like to see in my trades as well too. And that's it. That's how I use it. I don't ever use the fib by itself. I always like to have other factors that also support the fib as well too, because when I was just trading the fib by itself, it was very inconsistent and led to me taking some high probability trades and some low probability trades as well too. So I learned to factor in other factors with my Fibonacci tool. So I hope you guys enjoyed this video on how I use the Fibonacci retracement tool. If you have any questions or any tips, leave it in the comment section below. And remember, take all of my advice with a grain of salt. I'm just simply sharing what has worked with me. And until next time, guys, peace and love.